Hey, what's going on, guys? Leo, welcome back to the channel. There's a lot of fear in the market right now. There's a lot of people that are really worried that we're going to be heading into a recession in the general economy, and there's a lot of people worried that this is it, that the crypto bull run is over and we're headed for another 2 years of just choppy madness. And let's take a look at some data. Let's cut out the FUD and see what's actually going on here. Two things that I want to take a look at here. So we're looking at the PMI data. Now, on the top here, this is the ISM for non-manufacturing, meaning this is going to be services, which make up about 70 to 80% of the economy. So on the bottom chart, we're looking at ISM for that includes manufacturing. Now, whenever these are above 50, it means that our economy is expanding. It means that there's a lot of demand for manufactured goods. It means there's a lot of demand for services. So what's interesting here is that we're getting reports that, GDP is declining, right? So we just saw the Atlanta Fed come out that they're projecting the first quarter's GDP to be declining by, I believe it was negative 2.8%. But what's interesting about that is if we come in and we look at the manufacturing, we're seeing that the ISM is rising. And so what does that mean? That means that the demand for manufactured goods in America is increasing, okay? Now, if we take a look at the services, we're seeing that services are increasing as well. So why would our GDP be declining if services and manufacturing demand is going up? I don't think it would. So I think that what we can take away from this data is that this doesn't look like we're headed into a recession, in my opinion. If we look here at manufactured goods, in fact, for about 16 months now, the ISM has been below the 50 mark. So we're just now getting into a period of expansion. By the way, if you found the content valuable, hit that like and subscribe button. I really do appreciate it. So just continuing on here, with manufacturing and services increasing, it becomes very difficult for us to go into a negative GDP environment because you would need something really big and crazy to happen to offset the GDP, since manufacturing and services basically makes up all of our economy for the most part. There's not much else outside of this. So, I think that it's a bit overblown to say that we're headed into a recession. Now we come over here, we take a look at the Bitcoin chart. What you'll notice is that we're still in our uptrending channel. So everybody's panicking, this is the end, we're done, crypto bear market. But if you look at the channel, we're still intact. This is a price action trading channel, and you'll notice that on the lower end here, price is touching, and then it moves away, moves to this top side of the channel. And the ideal here is that the price is very tightly contained within this channel. It's very neat. And so right now on the daily time frame here, we're coming right down to the bottom side of this channel. If we look at the RSI, we're printing bullish divergence here, right? So, what we have is we have bullish divergence coming in right at the bottom of this channel. And so what I expect to happen here is I expect we bounce. I expect that, we bounce, maybe trend sideways a little bit, and we keep going higher. Now, there is talk that because the market's moving down, right? And a lot of this is pretty much generated by the Trump dump. It's basically he's causing a lot of fear in the markets, a lot of uncertainty because of the trade war and everything that's going on. And so and one reason for that is that, so we take a look at the I don't know how to say that, Kobayashi? I don't know how to say that. But they're speculating that the reason that he's causing all this fear and uncertainty in the market is that he wants interest rates to come down to be able to refinance the United States debt. I think that's part of it, but I also think that he's trying to get a lot of the bumpy stuff out of the way in the beginning of the presidency. Not necessarily that we're in a really bad environment for the economy, but it's a very uncertain environment. You have on one hand, people are very scared that all the tariffs are going to end up causing a recession, and that's where a lot of this FUD is coming from in the market. And then on the other hand, there's people saying that, well, this is going to allow for a lot of prosperity. He's getting all this stuff out of the way early on, which is kind of what I think. I don't think that this is going to lead to a recession because I think that it's more negotiation type tactics to get what he wants. So let's take a look here because there's a lot of interesting data. So in 2025, 9.2 trillion of US debt will either mature or will need to be refinanced. The quickest way to lower rates ahead of this colossal refinancing would be a recession. Now, I disagree with that to an extent that you don't need a recession in order to get interest rates down. So let's take a look at the data from Cleveland Fed. So Cleveland Fed is predicting that CPI data for March is going to come in at 2.47. The Fed has said that they're trying to get inflation down to 2%. So we're less than 50 basis points from being at the Fed's target. So I don't think we really need a recession to bring it down 0.5%. So what I think that will bring it down 0.5% is a lot of fear, a lot of uncertainty, a lot of craziness that the president is causing right now. So I don't think that we need to be pushed into a full-blown recession. It's not like we have 10% inflation anymore. That's all behind us. We're actually very, very close to Fed's target. So going on in the little report here, they're basically saying that why a recession would cause interest rates to come down dramatically. And there's a little bit of nuance that I want to say here. So a lot of times the reason that a recession is triggered and you have these lower interest rate environments is because as rates go higher and higher, people in leveraged positions, they end up breaking something. So whenever something breaks, the only way to remedy that is through stimulating the economy, right? So you have to cut rates, makes the debt burden easier on people. And so what they're basically showing here, for example, back in 2020, things started to break, and so they had to cut rates very quickly, and that's how we got down to near 0% interest rates, which stimulated the economy. Now, that was because of the whole COVID thing. Now, you go back all the way to 2008, what happened there? Well, interest rates were too high, people were over-leveraged, they bought a lot of bad mortgages, they put out all these bad mortgages, and so that you had this huge debt burden the economy was carrying, and so the Fed started cutting interest rates to make that debt burden easier to hold. So now that the question kind of becomes, do we need something to break in order for interest rates to come down? I don't think we do. I think that the fear and uncertainty that the president's causing is going to be enough to bring inflation down that extra 0.5%, and then the Fed will have an excuse as to why they can cut rates. So continuing on here with this report. So it says on January 25th, the president claimed to have a solution to the Fed's 3-year battle against inflation. He's demanding that OPEC were to lower oil prices. Now, this would bring down inflation quite a bit because oil is tied to literally everything from literally the gas in your car all the way to ladies' lipstick. It's literally in everything that we use in our daily lives. And so if the price of oil comes down, the cost to manufacture all these goods comes down with it. So that would bring down inflation, but I don't think that that's necessarily the key to bringing it down right now. I think that the fear and uncertainty in the market, that's going to suck a lot of liquidity out of the market as the markets continue to come down a little bit. So moving on to the kind of the meat and potatoes of this thing, it says that the maturity schedule for the 9.2 trillion of U.S. debt is heavily weighted for the first half of 2025. Between January and June of this year, 70% will need to be refinanced. The average rate of this debt is set to jump by an entire percentage point. So what I think that we can kind of take away from this report is that sometime between now and June, I expect something to happen where the Fed decides, hey, we're going to start lowering interest rates pretty aggressively here. So I think that what that's going to be is that they're basically going to see that inflation is coming down. We're already seeing the March report showing it was 2.47% for CPI data. So if that starts coming down even quicker, maybe it undershoots it, the Fed's going to have a really good excuse to start cutting rates. They're going to turn on that money printer, and risk assets like Bitcoin and crypto are going to soar. Another thing that people aren't really paying attention to is that if we take a look at the M2 money supply, it's starting to go up, but it really hasn't dramatically gone up in the United States because we've still been in a quantitative tightening environment. And what's interesting about that is even if we're in a quantitative tightening environment like we've been in, the price of crypto and Bitcoin, Ethereum, and stocks have been rising. So, I mean, imagine once the money printer gets turned back on, what these assets are going to do. I mean, they're just going to go through the roof. So I expect that it's going to be a little bit choppy here for a few months. I think that the president is going to end up resolving a lot of this trade war. I think a lot of it's going to be resolved, and we're going to have more certainty in the market. We're going to have less FUD. Interest rates are going to come down. And I think that what we're going to see within crypto is we're just going to see an extended market. I don't think the bull market is over. I think that this is just going to be an extended market that moves out into 2026. The more I look at it, the more it feels like that's going to be the case. We have global adoption at a rate that we've never seen before. We have countries talking about having their own stable coins now. The European bank, central bank, just announced that they're going to have their own, not a stable coin, but a digital currency. So we keep seeing this massive adoption. It tells me that this is going to be a longer, more prolonged cycle than what people have been expecting. And that really makes a lot of sense, because the halving narrative, it really doesn't make sense, because every year we've seen a reduction in the magnitude at how high prices have gone. So the first bull run was, as a percentage, the most extreme, and then the next one was a little bit less, and the next one was a little bit less. And so the reason for that is because the halving, it doesn't have as much of an effect. You have the price, you have all this miner sell pressure that gets halved, right? Because the miners, they have their fixed costs, so they earn their Bitcoin, they sell it, that gets cut in half, and you have this spring effect where the market just shoots right up. And so that effect is becoming less and less, and what is going to have more of an effect is global adoption, where you have large countries, companies building and buying cryptocurrency. And that's going to have more of a buy pressure, as opposed to what the halving has had, which is a reduction in sell pressure. And so I think that for many years now, we're going to start seeing this cycle change. I don't think it's going to be a 4-year cycle anymore. I do think it's going to be tied to the liquidity cycle with the M2 money supply. I just think that the halving is going to have much, much less of an effect. I think that the ETFs alone have a greater buy pressure than the halving sell pressure reduction, if that makes sense. I feel like I made that a little bit confusing, but hopefully you understand what I was saying. And so with all that said, I mean, to me, this is a time to accumulate. If you always try to keep a little bit of cash on the sidelines, and what I like to do is I just accumulate more, is I just add it into the portfolio, every month, just add a little bit more or whatever you can to your retirement, your investment portfolio. And that's how you build wealth over the long time. You buy when other people are fearful, and you sell when other people are greedy. I know that's just an old-fashioned saying that people say, but I mean, it's absolutely true. Whenever other people are scared and people are telling you, oh no, this is the end, that's whenever you want to be buying. And whenever they're saying, oh my gosh, we're going, we're at $1 million and we're going to 3 million, that's when you want to start thinking about taking some profit if you get a little too heavy weighting in Bitcoin in your portfolio. So I think that a lot of this is overblown. I don't think that we're going into some massive recession like 2008. I think that this is just a really choppy, uncertain environment within the economy right now. So until next time, y'all take care.